Hello again. Welcome back. This is Wade into Wealth. I'm Chuck Wade. My brother Ethan Wade is here as you have been for every one of these episodes up until this point, and I think that's the objective, to keep it that way.
That's the goal. You haven't kicked me out yet.
Yeah, no, well, I'm trying, but just finding it's difficult to find a way to get it done. So
We'll keep it that way.
I'm going to tell you a little story, and
Here we go.
now I hope we'll shine some light on.
Usually
where we're going
the
today.
stories that you have in the beginning, I often have to wonder how does this apply to?
So a couple years
topic.
ago, I was doing a race at Letchworth. You run around the gorge at Letchworth State Park. And in trail running, there's a lot of equipment you can use. Most people will wear like a hydration, like a vest. You carry your water bottles in. You can carry some food, maybe a rain jacket, poles if you want to hike with them. And you also bring what's called a drop bag, which halfway through the race, this was a 40-mile race, halfway through the race, they'll put your bag so you can, if you want to change shoes, if you want to have some extra dry clothes. And people pack a ton of stuff for this. And I am guilty of this too. I get multiple shirts, multiple pairs of shoes, all this stuff. So in the beginning of this race, it's 7 or 8 miles in, and I'm moving along at what I think is a decent pace for me. This guy passes me who's wearing a button-down shirt. Nobody races in, he's wearing not like a dress shirt, but like a casual dress shirt, I guess.
Short sleeve or long sleeve?
It's short sleeve, but everyone else has like these sweat-wicking shirts. I mean, you've got athletic
so basically
clothing
you had Charlie Sheen running the race.
This guy wears a shirt like you'd wear it fishing. Okay.
Yeah,
He's got a button-down shirt. He's got khaki shorts. Now, again, nobody runs in like khaki
Were
shorts.
they the ones that you could zip off at the knee and they could be pants or shorts?
Could have been.
It
could have been. And he's carrying a jug of water like a football. He's got this old hat on, long beard. And I think to myself, I go, who is this guy?
It might be Forrest Gump.
He could have been.
Mm-hmm.
Now, I finished the race. This guy finished the race so far ahead of me. And initially I thought, who is this guy? Like, I've got multiple water bottles. I've got a pack. I've got food. I've got a pair of shoes to change into. This guy's out here in a button-down shirt.
Does it every day.
Halfway unbuttoned, khaki shorts, old hat, and he's carrying a jug of water with him. And to me, what that showed is that the gear doesn't matter.
Mm-hmm.
You can have all the bells and whistles, but you just have to do the work. And sometimes all you need is a jug of water, and simple is better.
Half undone button-down shirt.
Half undone button-down shirt.
Khaki shorts, maybe a pair of white New Balance sneakers.
Turns out the guy actually works at Letchworth, knows the park in and out, but he just goes and shows up the day of the race every year.
There's a race here. I'll do this.
He goes, well, I'll see how far I go. And he finished, I don't know, in like the top 20%. Simple is often better.
Oh, I mean, yeah, I think you can apply that to pretty much everything in life.
Most everything. And so you don't always need all the bells and whistles. You don't always need the gear. You don't always need the latest technology in whatever you're doing. And so today we're going to talk about buffer funds, which...
Those are the poles. Those are all the food. That's all your massively packed drop bag.
And some of it you need, but it's a kind of investment that says, well, it's going to protect you from losses in a bad stock market, but you'll still make money if the stock market makes money. It sounds
just not too much.
Great.
Just not too much.
Just not too much. And I remember years ago when I started, and someone came in and telling us about this mutual fund that it'll protect your losses. If the market goes down so much, it'll sell all the investments. You won't lose any more money. And I remember going to our the chairman of our firm, George Conboy, and saying, this sounds pretty good. I didn't know anything at the time. And he just said something like, that is complete crap. You want nothing to do with that.
Yep.
And then he explained why, and I thought, oh, yeah, okay, that makes sense. So buffer funds...
Well, and our industry has this. We have a new part of our business that we acquired close to a year ago, which is Brighton Securities Capital Management. It's an index-based approach investing strategy. And the tagline is great because it's the power of simplicity.
Yeah.
But it talks about how our industry as a whole feels the need to complicate to validate. Mm-hmm. And in a lot of ways, we have these products or these investment structures that are equivalent to the person who just tells you what you want to hear.
Mm-hmm.
Because everybody wants to hear, you can limit my losses and still give me returns similar to what the stock market can give me.
Yeah.
It won't happen.
Yeah, well, that's like, and I rode to work on a unicorn today.
Yeah. Well, I saw you park. I know you did not.
I did a good job parking today.
You did a heck of a job parking
I do
today.
appreciate that. No, but it's true. It is true. And I have found in many cases that if you want to try and sound smart, if you want to try and use jargon terms and big words, some people may buy that initially because it's almost like they want to think, oh, this guy sounds really smart, so he knows what he's doing. I have found the most success in the time I've been doing this is actually the complete opposite, is in the ability to break a concept that may be complicated down into the most simple terms possible so that someone can understand it.
I have long felt that the smartest person in the room is not the person who uses the biggest words and confuses everybody.
It's usually the person that speaks less.
The smartest person in the room usually listens a little bit more and can explain things in a way that everyone can understand. And so if you're looking at an investment strategy or someone is explaining an investment strategy to you and you walk away from it confused or not able to connect the dots, sometimes that means it may not be the best thing.
No. And if you are confused by it, you are probably not alone, and that others are probably also confused as well, but may be afraid to speak up, may be afraid to ask a question and say, hey, I don't get this, but it sounds good.
And the most important part with anything when it comes to investing is when the times are tough to stick through it.
Mm-hmm.
If you don't understand what it is that you own when those challenging times come, because they will come.
Right.
If you don't understand it and if you're not comfortable with it, you're going to be more likely to abandon that strategy at the most inopportune time. If you understand it, and you don't have to know every little detail about it, but if you have a general idea of what the big picture is and the overall goal and strategy, that when the challenging times come, you're going to be more likely to go through those situations without making a decision that you will come to regret 10, 15, 20 years later.
Absolutely correct. So let's take a pause and explain how these things work.
Because a lot of money has flown into them this year.
This year, nearly $6 billion.
Which makes sense. Why?
The market's down.
Because the market's down.
Choppy markets.
We all want the person who's going to tell us what we want to hear, not the person who's going to give us the honest truth.
Last year, about $3 billion flowed into these funds. When we say flow into these funds, people are investing in these funds. So last year, around 3 billion people invested in 2021. Now, 2021 was actually a pretty decent year. This year,
$3 billion, not 3 billion people.
$3 billion, right. 3 billion people would be half the world. It's a different number.
It is.
$3 billion, double that this year.
Because the market's down.
Market's down.
And it always makes us take stock of, well, this hurts, and seeing my account go down like this stings. So in the future, how do I prevent this?
Right. Or how do I stop the bleeding?
Right.
Okay. So a buffer fund, the majority of these are ETFs. They are exchange-traded funds, but it's an investment vehicle, doesn't actually own stocks or bonds.
Yes, this is where it gets really simple.
And look, this is going to get confusing. I was confused. I had to read this multiple times and rewrite this a few times to try to make it the least confusing. I don't think I succeeded, but onward we go. So they don't own stocks or bonds. They own options contracts to sell specific stocks at certain prices that can limit losses. And the funds sell call options, which give the buyer of these options the right to purchase for a specific price. If the shares rise beyond the call price, the options buyer exercises the option. That's how potential gains are limited in the fund. And if you're confused by now, you should be.
Yes.
You absolutely should be. More simply put, the goal of these kinds of investments is to limit the losses, and the but is what is important here, they limit the gains as well. It's not free. They are expensive. We'll get to the costs, the actual costs in a moment. But the biggest cost is that the gains, the growth is limited as well.
We've talked about it on this very
we're like a
podcast
broken
before,
record when it comes to this.
where you're compensated for your risk. So if you're going to seek a strategy that will limit your risk, there is nothing out there that will limit your risk and give you the maximum potential of the upside of the stock market. Anywhere that your risk is limited, your returns will too be limited.
Yeah. And people prey on the fear of others.
That's exactly what this is.
100%. When you are afraid or you have fear or anxiety or uncertainty, you are you become vulnerable to hearing what someone else is going to say that may directly address that fear or anxiety in the short term.
No one gets these when the market's up 15%.
No.
They don't.
No.
And in fact, what you're going to see is that when the market's up 20%, that we talk about asset inflows into these funds this year because the market's down. And that's what everyone wants to hear right now. But when the market's up 20%, you're going to see asset outflows.
Right.
And it shows how reacting to the market is a fool's errand.
Yes.
Have a simple strategy that will go through the good and the bad times together. But by simply jumping around from investment to investment based on the way the wind is blowing today is a strategy that will set you up for failure. It may not be failure,
Frustration.
but it will hold you back from what you otherwise would have been able to achieve if you took the simple, yet sometimes more challenging route.
Yeah. So right now, the S&P 500 II is down around 14% on the year, give or take a couple of points or a point. The Innovator S&P 500 Buffer Fund, which is one of the larger funds out there, is only down 5.5% this year.
Innovator S&P 500 Buffer Fund.
Right, yeah.
The more words you have, I paraphrase George, our chairman here.
The more words
the more
you have,
complicated
the worse
the name of the investment
probably
is.
Yeah.
Right.
Right. The Innovator S&P 500 Buffer Fund.
Just need a couple more descriptive words in there.
All right, it's down 5.5% this year. That, you know what? At this moment in time, I can see where you'd be happy with that. How these funds, this specific fund works is that you are protected. Protected is in quotation marks from the first 9% of losses. The market goes down 9%, you don't lose anything. Pretty good deal. Now, if it goes down more than 9%, now you start to lose money. You start to see a decline in value. Your gains are capped at 18%. Capped at 18%. So you're not going to make any more money than that. So, you asked this, you said, what did they do in 2020? I went back and looked. So the market dropped at its worst in 2020, in case you'd forgotten. That was the year we learned about what COVID was and the pandemic started.
The pandy.
At its worst, the S&P 500 was down almost 40%. At its worst.
Which meant these funds would have been down 31.
I went and looked. They were down. It's not exact. They were both between 20 and 25%.
Okay. All right.
Okay. Do you remember what the S&P 500 returned in 2020 for the year?
Was it 15, 17%?
Higher. It was like 19 and a half, almost 20%.
Right.
Including dividends, it was 21 or 22%. The Innovator S&P 500 Buffer Fund finished the year up 7%.
Sounds about right.
Here's what's important to keep in mind. Losses with respect to investments do not have to be permanent. They're only permanent if you make them permanent. If you choose to sell, if you choose to panic when things are getting rough. And we've hammered this point, but nobody sells, people typically sell at or very close to the bottom of a market.
Because we're reacting to the way the wind is blowing in that moment.
We're reacting. But losses don't have to be permanent. Losses are temporary. If you look through the course of history, the losses have always been temporary. The downturns, 2008, 2020,
they're not the norm.
This period of time we're in right now will be temporary. And where is it? I had this statistic here. Okay. Markets rise more often than they fall. The S&P 500's averaged a return of 11.8% since its inception in 1957 when that index started being tracked. There have been 28 years with a negative return. So basically 1 in 4.
Mm-hmm.
Every 4 years is a negative year. There have been 24 years with a gain of greater than 15%. Nearly 40% of the time, the return's been greater than 15%.
But you wouldn't participate in all of that if you had a buffer fund.
No, or you'd likely miss anything over than 18% in this one fund. You would miss out. So yes, maybe one in every. And I just said a negative year. Some were not 9%. Some years you wouldn't lose any money.
Sure, yeah. But what's interesting is that when we go through those statistics and we talk about how this year the buffer fund is down 5.5%.
Yeah.
I think to myself, well, yeah, we have clients who are only down 5.5%.
Sure.
We're not using buffer funds.
No.
It's because we're using a balanced mix of investments.
Quality
And
investments, right?
there's a way where it doesn't have to have all of these bells and whistles and this overly complicated name, where you can achieve the same type of results
Mm-hmm.
in a more streamlined and transparent method.
Yeah. Also, these funds do not pay dividends.
Sure.
Because they don't actually own any
They don't
investments.
own any.
They
Yeah,
own
they just own
options
options.
contracts,
Yeah.
so they don't pay dividends. Okay, so there's that. They also have very specific time frames. The time period each fund usually resets after a year. So if you invest in this fund at a point during the year, well, you may not get the same protection.
Sure.
It depends. It's
Right.
not as promised if you're investing in the middle of the year. And so there's been
Because their triggers are based on
Right.
certain numbers
Right.
that would have to start the year. So
correct.
yeah.
So there have been nearly $6 billion worth of money has been invested into these funds this year. I doubt the majority of that happened in January.
Oh no.
No, it has happened over the last probably 4 or 5 months.
Absolutely.
So and these funds also will cost almost 1%.
Which
Annually.
for an exchange rate, now an exchange traded fund is basically the equivalent of the cousin of the mutual fund.
Right.
And one of the claim to fames of an exchange traded fund, or as we often refer to it, an ETF, exchange traded fund, is that they have lower internal costs. The Vanguard S&P 500 ETF charges like 0.04% internally.
Right.
So an ETF that's charging close to 1 is more on the expensive side, but certainly not the. And I think it's also fair to say, like, these things aren't the end of the world. We have seen stuff that is much worse than this.
Yeah.
In terms of the impact that it has to the investor. It's just a classic case of these are made for what people want to see,
Right.
what they want to hear, and it's a solution that when you're nervous, you can have this, and it may help you feel better about it. But there's also plenty of other options that you can achieve like results with a much more transparent and a much more streamlined approach.
In theory, these can work.
Yeah.
Yeah.
I've seen plenty worse, but that doesn't mean
Right.
that they're the best option available.
There is I was reading an article about athletic greens. You hear
Greens or grains?
Athletic Greens. Athletic Greens, the
Got it, yep.
supplement. I mean, if
Okay.
you listen to podcasts,
Never heard of it.
we're not sponsored by Athletic Greens, but a lot of podcasts are sponsored by Athletic Greens, and they claim to provide you with all these vitamins, and it's like $80 a month to subscribe to this powder.
Okay.
Okay, it's a powder you get. It's supposed to give you all these 70-plus vitamins and nutrients. I can't remember where the article was, but they had a bunch of nutritionists.
Does it promise to make you look like Dwayne Johnson?
I don't know. I mean, it's implied maybe, but the dietitians and these nutritionists said, yeah, this is a really expensive multivitamin.
Yep. Of course it is.
It's a really expensive multivitamin, and if you're eating a balanced diet with a decent mix of fruit and vegetables, you really don't need this. You're probably getting the same nutrients that other people are paying $80 a month for.
People pay it.
Well, I think we just shot our chances at having Athletic Greens become a sponsor of Wade into Wealth.
No, but we may have some folks from FAFSA after
after last week. Your
laying out
ability
how to properly pronounce
that
it.
word. Here's the point. When you hear of something that sounds too good to be true or sounds as if there is no risk involved, well, if it sounds too good to be true, it probably is.
Yeah. Just look at your very expensive multivitamin of the
Right.
Athletic Greens.
Yeah. Or you know what? I'll tell you what. The pack I had on my back and the amount of water bottles I had and the shoes I might have worn, it didn't get me to the finish line any faster.
Nope.
No, what would have gotten me to the finish line faster was maybe eating better during the period in which I was training and, not skipping workouts.
Well, and now you know you need khaki shorts,
Yeah.
a half undone button down, and hold a water bottle like a football.
Yeah. There is a cost to everything. And the cost to reducing your risk is very often the creation of long-term wealth, in my view.
Yeah. Yeah. You're
giving
capping
up-
your
right.
returns.
Capping your returns.
Yep.
But the difference is that losses are temporary in investments.
Mm-hmm.
We have always gone on to new highs.
And there's other alternatives
Right.
that are much more simple that won't cap your returns, but
But-
will still give you some protection on the downside by having, similar to the balanced diet, replaces the need for the athletic greens. A balanced investment approach and strategy replaces the need for an investment structure with all the bells and whistles that tells you just what you want to hear.
A 60-40 stock to bond investment strategy
achieve the
is,
same thing.
is going to give you the same returns with much greater simplicity. Also, will probably give you a little more income if you're someone who's retired. Not probably.
It
would
would.
because these kinds of funds don't pay any dividends. They don't pay
Right.
any. They don't pay any income. That's a key part of investing, whether you're 30, 70, or 100.
Well, and let's face it, the investor who's trying to limit their losses isn't the 35-year-old who's putting money into their
No.
401k. It's the
Right.
person who's retired, and oftentimes that income is a really important need, if not the most important need, when you're in retirement. So we can't lose sight of that.
No, and I know dividends, interest, income is part of many conversations we have each day with clients.
Yeah.
Very important.
Mm-hmm.
So anyway, that's buffer funds. There's a lot of them out there. They sound great, but buyer beware. We'll be back next week.